Qualcomm jumped 8.4% today, closing at $237.53. That is not a rounding error. For a company with Qualcomm's market cap, that single-day move represents roughly $45 billion in added market value. To put that in perspective, $45 billion is larger than the entire market cap of most S&P 500 companies. So the question isn't whether today matters, it clearly does. The question is, what exactly did the market just decide? We're not here to predict tomorrow's price. We're here to read what today's price is actually saying about the AI chip race and where Qualcomm fits in it. To understand why this move is significant, you need to understand where Qualcomm sat coming into today. The broader market has been cautiously constructive. SPY is at $739 QOQ at $713, and the VIX is sitting at 1838, which signals elevated but not panicked volatility. Qualcomm, though, had been a relative laggard. While NVIDIA and the data center AI trade dominated headlines through 2024 and 2025, Qualcomm was fighting a perception problem. Too much smartphone exposure, not enough hyperscaler leverage. The stock had been treading water, underperforming the Nasdaq by a meaningful margin heading into early May. So today's move isn't just a one-day pop, it's a repricing event, and those are worth understanding. Here's the structural picture. By mid-2026, the AI chip market has stratified into distinct layers. NVIDIA owns the top layer, data center GPU clusters for training and large-scale inference. That's a well-established fact at this point, but below that sits a second enormous layer, edge AI. This is AI running on devices, phones, laptops, automotive systems, industrial sensors, where you can't always send data to a cloud server and wait for a response. On-device AI needs chips that are fast, power-efficient, and cheap enough to put in a $700 smartphone. NVIDIA's H100s and Blackwell GPUs are not built for that. Qualcomm's Snapdragon family is. The two companies are not directly competing. They're playing different parts of the same AI infrastructure build-out. That's a key insight the market spent most of 2024 and 2025 underweighting. So what actually triggered today's move? The most likely catalysts are Qualcomm's Q2 2026 earnings results or a significant analyst upgrade tied to forward guidance on AI-capable Snapdragon chip orders. Here's the signal worth watching. Handset OEM design wins are accelerating. Samsung, OnePlus, and a wave of Android manufacturers have been ramping on-device AI features. Real-time translation, photo processing, voice recognition that doesn't require a cloud call. Every one of those features runs on a Snapdragon chip. Each design win generates both upfront silicon revenue and, critically, licensing fees. That licensing revenue is recurring and high margin. It doesn't disappear when a phone cycle ends. It resets with the next generation. That's a very different business model than selling discrete GPUs. Now let's talk about the PC and server push, because this is where the story gets more complicated and more interesting. Qualcomm's Snapdragon X Elite chip for Windows PCs launched in 2024 and represented the company's first serious attempt to break Intel and AMD's lock on the laptop market. The reviews were strong on efficiency metrics. Adoption has been gradual. Windows on ARM has a software compatibility history that took time to work through, but by 2026, the ecosystem has matured meaningfully. On the server side, Qualcomm's Orion-based infrastructure chips are being tested by hyperscalers, including AWS. Traction there is slower than Qualcomm's mobile business, but the optionality is real. Even a small share of the ARM server market would be material at Qualcomm's revenue scale. The market appears to be starting to price that optionality in. Let's zoom out to the licensing business, because it's the part of Qualcomm that gets the least attention, but does the most structural work. Qualcomm's QTL, Qualcomm Technology Licensing, segment earns royalties on virtually every 3G, 4G, and 5G device sold globally. As phones become AI-capable devices, the royalty base doesn't shrink. It expands because higher-value devices carry higher average selling prices against which royalties are calculated. This is an annuity stream embedded inside a chip company. It's also the segment that has historically been the target of antitrust scrutiny from regulators in multiple jurisdictions. That regulatory risk is real and has weighed on the valuation multiple for years. But so far in 2026, no new major licensing challenge has materially disrupted the segment. If earnings confirmed QTL stability or growth, that alone would explain a significant portion of today's repricing. None of this means the move is risk-free or that the story is clean. There are real structural headwinds Qualcomm carries into the second half of 2026. First, customer concentration. A significant share of chip revenue flows through a small number of OEM relationships. If Samsung or another top-tier customer designs around Qualcomm for a product cycle, revenue can drop sharply with limited warning. Second, China exposure. A meaningful portion of Qualcomm's handset revenue comes from Chinese OEMs. That market has been subject to ongoing geopolitical and regulatory friction, and any deterioration in U.S.-China trade policy could hit Qualcomm's top line faster than most investors model. Third, the Apple overhang. Apple has been building its own modem chips in-house for years. As Apple's in-house modem matures, Qualcomm's modem revenue from Apple, which has been a meaningful contributor, will decline. These are known risks. Today's move doesn't erase them. It means the market is weighing them against the AI tailwinds and currently concluding the tailwinds are larger. Here's the broader takeaway that extends beyond Qualcomm specifically. What today's move signals is that the market is starting to differentiate within the AI chip trade, not just rewarding NVIDIA exposure and leaving everything else behind. The thesis is shifting from who makes the biggest data center GPUs to who owns the full AI compute stack from cloud to device. Qualcomm has spent 2 years positioning for the device layer. MediaTek, Apple Silicon, and a handful of others are in the same fight. The investors who are paying attention aren't just watching H100 shipment numbers. They're watching on-device AI adoption curves in mid-range smartphones, ARM laptop attach rates, and royalty revenue per AI-enabled device. Those are the metrics that will define the next chapter of this trade. Today's 8.4% move in Qualcomm is the market's way of saying, we're starting to look at those numbers now. So there it is. Qualcomm, $237.53, up 8.4% on May 11, 2026. The proximate trigger was likely earnings or a major analyst revision. The structural story underneath it is a company that spent 2 years looking like a smartphone-era relic, while quietly building out an AI edge compute franchise, licensing, PC silicon, and a growing server optionality play. Whether today's move gets extended or fades depends on execution and macro. But as a signal of where market attention is shifting in the AI chip race, away from the single-horse NVIDIA trade and toward the broader stack, it's worth taking seriously. We'll keep tracking the data. As always, nothing here is financial advice. If you want to see the numbers behind this story, the sources are in the description.